Hi, everybody. Welcome back. Took a week off there. Welcome to Financial Friday Fundamentals. I'm Brett. We are going to talk about something this week that I think is a little apropos. We're going to talk about investing in uncertain times and finding opportunities in volatile markets. Also, we're going to touch on some strategies for how to invest when markets are at all-time highs. Um, so this is going to be a little bit more advanced. Um, so some strategies to put into play, um, beyond just putting some money into index funds and bonds. So, if you're not comfortable with doing some more advanced things, um, you know, like with everything, small steps, incremental, um, just approach with caution. You don't want to jump in and do everything all at once. Um, and so, easing in and taking things a little bit at a time, and spreading things out. Same with our strategy with index funds and bonds and everything else. The same strategy is going to apply. So um, the you know is what I would still recommend in that case. So um, the be disciplined, I guess, is the best word. It's important to not let our emotions get the best of us when we're approaching these things, because um, that's how we can get trapped and how we can get um, run over by this stuff. So I'm going to break down some practical strategies to navigate uncertain markets and avoid the emotional investing mistakes. Um, and we can take advantage of some hidden opportunities that other folks might overlook. Um, so we're gonna find value in the market. We're gonna look for some underperforming but high quality investments. We're gonna look at the power of patience. How strategically holding cash can set us up for the right opportunity. Um, we're gonna take a look at how and understanding market correlations, understanding how bonds, REITs, those are real estate investment trusts, oil, inflation, how they all interact and what that can mean for a long-term portfolio. So I mean, all of these things play together and give us a bigger picture and can give us the information that we need in order to um, make decisions and open up these opportunities for us. So let's jump right in. So first of all, finding opportunities when markets are high. So I've heard people say, "Oh well, the stock market's at an all-time high. Like how I shouldn't start investing now. The market's at an all-time high." Well, first of all, um, I'm gonna actually do a little quick segue here. I forgot to set this up before I got started because I had a couple of things going actually in the stock market this morning that stopped me from finishing what I was working on for this. So I apologize that I wasn't entirely ready, but give me just a moment and I am going to pull up this image quick. And I just want to show you something that I've done here just recently. So this is showing you just current snapshot from this morning of uh, my long-term portfolio. So let me just make that a little bit bigger for you here. So this shows I've got a couple of index funds in here, and then I've got a REIT, and so that's what O is. That's a real estate investment trust. And I've got Amazon, Berkshire, Coca-Cola, Walmart. Another REIT is the APLE. That's a real estate investment trust that owns some vacation, like hotels and other vacation rentals. TLT, that is a 20 plus year bond ETF. NVIDIA, and then Oaktree is a specialty lending company, so they do like lending for specialty projects like home remodeling and things like that. Dow is Dow Chemicals, UPS. ACAM is a commie. They're a technology like network company and stuff like that. AES is a energy company. CPB, Campbell's, we know them, Hormel, and Fidelity. So this is my long-term portfolio. A lot of these names I've had for a while, and some of them I've just picked up recently. So I wanted to show this to you because there's only 3 in there that are in the red for total. The not the farthest right column, but the second farthest to the right. Everything else is in the green, and we've had several days here in a row that the market has been down. And the reason I bring that up is because a lot of these names, the ones towards the bottom, the smaller holdings, I've picked up recently. And so this is the strategy I'm going to show you here today is these were picked up while the market has been at an all-time high. And so how do we find these names? How do we know what to look for? So one of my favorite tools is a website. It's free to use. It's called Slick Charts. So what we do is we go to slickcharts.com, and you can go to the S&P 500 tab, and you go to component performance. And what we do is we go all the way to the bottom, and we find the names on the S&P 500 that are the worst performers on the year. And anybody that's down the most on the year, they're the underperformers for the year. So they are the laggers for the year, right? So what we'll start looking for are names that we know, that we use every day, names we're familiar with, big value names that we're familiar with, right? So at one point, some of the names that were on here that I saw were like Hormel, Campbell's, Fidelity, UPS, right? Some of these big names that I've known and seen all my life. And so, you know, these names are on here. They're probably up a little bit now because they've gone up a bit since I got them. But so like Fidelity is there. And then scroll up a little bit more. We've got I'm sure they're in here somewhere. Dow Chemicals was one. And then Campbell's, UPS. So they're all down they're all down on the year. And then what I do is I take those names and I can go into my Fidelity, and what I'll do is we'll take a look at, for example, let's just take a look at Dow because I remember that. And then we'll take a look at a 5-year chart. Now Dow is near 5-year lows. But if I look at a 10-year chart, that was a fluke during COVID that it dipped below. It's actually lower than its 10-year low, minus the COVID dip. So this is a great pickup as far as let me just zoom this in a little bit for you here so that we can see it a little bit better. So if we see prior to its current price, its 10-year low was actually $40. So we're actually getting it $3 less than its 10-year low. So it's actually at a 10% discount to what it's been at as far as a 10-year low. And there's a 7.5% dividend. So on top of being 10% cheaper than it's been in the last 10 years, I'm getting paid 7.5% to own it. So this is a great pickup. So the market was at a 10, it was at all-time highs. Dow was at all-time low or 10-year low. It's got a great dividend. It's a name that's been around forever. I know it. I use it every day. There's, products that they make that I've been using my entire life that I'll probably continue to use for the next 10, 20, 30 years. And so, and it's in a sector that I don't have a lot of exposure to. So I have a lot of tech in my portfolio. I have real estate in my portfolio. I didn't have a lot of consumer staples in my portfolio. And so consumer staples is what they tend to refer to as a rotation sector. So when tech tends to go down, it tends to be a higher risk sector. So when things are going really good in the stock market, the investors tend to go for the higher risk. But when we see the downturn, which has been happening these last few days, investors tend to pull out of those and go towards more value and safer, which is like consumer staples and sometimes healthcare or energy and things like that. And so a lot of times the other sectors will go up while technology goes down. And so we've seen Dow and Campbell's and things like that go up. And so this has been a great pickup for my portfolio. Another one that I got was Campbell's. So another name that has been around for a long time. I picked this up right around here. I think we got it at around the $38, $39 mark. Again, or actually I think I might have got it around 36. But again, it's close to 10-year lows. So, and it pays about 4% dividend. So, um, another great pickup. It's a name that is in probably everyone's pantry, everybody's kitchen. You buy their products, you use their products. They're going to be around for a long time. So, um, this is just a way to check, you know, value names that are underperforming, that are available when the market is up, that you can get a good deal on. So, uh, another perfect example was a while back. So I actually have Walmart in my portfolio, but I picked it up around $54, $55. So, but this was back when in 2023, when the overall market was down. And so, uh, this was a good time when the market was down to find these value names that, even though they were up, um, it was a good time to pick up names that stood to benefit when the rest of the market was going to take off. So likewise, there's opportunity at all points of the market if you can see the trends that are happening. Um, so um, that's one of the big strategies that I use is the slick charts. Is I'll go through and find these underperformers, and I'm only looking for the really big names. I'm not just looking at anybody. I'm looking for the ones that I know, that I use every day, the biggest of the big value. Like, if I don't recognize the name right out of the gate as one of the like really big, I know them, I use them, I know they're going to be around. And then if I pull up the chart and it's not, something like another example is Pfizer. I was looking at this the other day. Like, Pfizer's way down, So that's at 10-year lows pretty much. So another great value pickup right now, even though the markets are way up. I mean, they're down the last several days, but when the stock market was at all-time highs, Pfizer was at 10-year lows. So, great opportunity to get into a strong company name at very low prices. And this is paying 6.5% dividends. So then you take those dividends and you can either get them in cash deposited to your account or reinvest them back into the stock, and it just buys more of that stock with the dividend. So um, we'll get into that in a little bit. So that's one of my favorite tools. Is I'll get onto slick charts when I've got cash that I want to deploy to, and it's for whatever reason not um, a time that I want to get more of an index fund for my long-term account. So um, that's what I mean when I talk about value stocks. Is they have intrinsic value. They are names that are not going anywhere. They're not the hot new thing. They're not the you know up and coming, or they're not some penny stock. They're the cornerstones. They're the blue chips. They're the big names that have been around, that that you use, that you're familiar with. Strong fundamentals. They've got good balance sheets. They are well established. and are at a good price. Um, and so um, there's different sectors to watch. So there's consumer staples, there's healthcare, there's utilities, there's communications, there's energy, there's financials, there's um, you know um, uh, I'm forgetting another one, but anyway, um, but those are all different um, sectors that you can watch, and there's tickers if you're actively watching those to kind of get an idea of which sectors are going. So there's like XLC, XLE, XLI, XLK, XLP, XLU, XLV. Um, they're different stock tickers that'll show you different sectors of the market and how they're performing. Um, so when I talk about having cash, um, it's not a bad thing to have cash in your account. Um, 10 to 20% of your portfolio should be cash. So in your long-term account, um, so there's you should have a separate account for long-term, which um, we talk about a long-term account being a retirement account, or at least a 10-year mindset, at least 10 years. If I'm not buying something, if I'm buying something for my long-term account, my intent is it's going to be in there for at least 10 years. I'm not selling things in my long term. I'm only buying and holding. Um, so holding cash in my long-term account is fine. I don't want to hold too much because then it's not being used as it's not doing as much as it could. But I also don't want to have none, because if an opportunity comes along, like the case of a Pfizer or a Dow or Campbell's or UPS or any of those, I want to be able to have the cash to be able to buy it when that opportunity is available. So 10 to 20% of my account balance should be cash. And in the Fidelity account, you can tell the Fidelity to have the cash be in a money market, and the money market is paying right now about 4%. Sometimes at one point it was up to 5%. It just depends on what the current rates are. But I mean, getting paid 4% just to hold cash in your account is pretty good. And you don't have to do anything. You don't have to move anything around, and it gives you a deposit every week. So it's a great way to have that flexibility and be ready for those opportunities. Um, so here's the big trip up, is avoiding the emotional part of it. There's so many times that I see people that panic, or they want to rush. They get FOMO, they panic buy at the highs, or they panic sell when things are low. So by holding cash, and you do the thinking ahead of time, and set your targets as far as when you want to enter. So here's a perfect example. I went through and I did my full list. There. That's the list of all of my entry points and prices. I went through and went on Slick Charts and told myself those are all of the names that I'm watching, and I told myself, here, these are the prices that I want to enter at. Like, so then I went into my brokerage and I set a price alert for all of those stocks and I said, if it drops below this price, I want to get a notification. And if it does, then that's when I can buy. If it doesn't, then it's fine. I'm not forcing anything. There's, be patient. The opportunities will come. There's going to be other opportunities. Like it's okay to wait. You don't have to force it. You don't have to rush anything. There's going to be other opportunities. I don't need to be married to any one of these. All of those are good opportunities. I don't need to own them all. And it doesn't matter which one, because those are all quality names. They're all quality value stocks. And they'll all do the job. They're, at those prices, they will all do what I need them to do. So that's how you can position yourself well when the market's up and still find opportunities to find entry points and be able to make use of cash. So if you're sitting on 50% cash, you need to be able to find ways to make that work, even if the market's at all-time highs. If the market's low, then it's a good time to just grab the index fund. If S&P's at all-time lows, or 52-week lows, great, start averaging down. um if if you look at your portfolio and you see that you're down on certain names, it's a good time that you can then start buying them at lower prices and start lowering your average price. If you're up on names, great, stay up on them. Find other opportunities. That's the trick, is when I see red numbers on my total gain and loss, all that means is that those are opportunities for me to lower my average price. The green numbers means those are doing good. Leave them alone. That's all it means. Like, it's simple. I'm not selling anything in my long term. The long term account does not have anything getting sold. So, and that's why I'm keeping things small. I'm only putting in the amount that I intend to leave in there, right? So we're just gradually growing that account. It's not an account that I'm planning on trading and making quick money and trying to like get rich and pull anything out. The whole goal is this is going to compound over time, and we want it to grow slowly, steadily, and build and build and build. This isn't a sprint. So the whole point is this is a very long game. So I'm going to show another thing here if I can get this pulled up. Let's see. Let's see if I can get this. I don't know if it's going to let me do it the way I want to do it. Here, let's see. Nope, that's not showing what I want to show. So never mind. We'll move on. Um, so the next thing we'll go over here is understanding market correlations. So, um, and you know, timing investments. So Warren Buffett said that time in the market beats timing the market, and that is absolutely true over a long enough timeline. However, there is some advantage to knowing some timing as well. So, because you can make some better decisions than others based on some market conditions and correlations. So, understanding how different assets move in relations to others can help you make better decisions as far as different entry things. So, first, the S&P 500, the major index that people use as a benchmark, versus bonds. So historically speaking, just in general, when stocks are up, bonds tend to go down, and vice versa. So if bonds go up, then that usually signals a slowdown, because if bonds are up, that usually means that it's kind of a risk off. That usually means people are trying to avoid risk. But it can also mean better opportunities in certain stocks, like we just talked about with that rotation out of riskier assets and into more value stocks. Um, so that leads us to some other indicators. So if bonds aren't uh, moving much, um, then we can also look at inflation and oil prices. So if oil prices drop, that tends to mean that inflation is also dropping. Oil tends to be a pretty good indicator of inflation. That can be a good thing for the broader market. If inflation's dropping, that tends to mean that the prices are going to be lower, people are going to be spending more. That tends to be good for um, the overall market. Um, so the only thing that tends to negatively impact is energy stocks, um, and you know shipping costs and things like that. Um, and then something that's very dependent on interest rates and bond prices are real estate. Home builders, real estate investment trusts, those things are very closely related. So REITs are oftentimes very closely impacted. So if bond prices go up, that means interest rates tend to drop, which tends to mean that REITs and home builders and home prices tend to be more attractive. So checking the price history over the last 5 to 10 years can help you determine um, whether or not that's uh, going to be a good time to add them, a good time to get in. Um, and you can also check um, the uh, the what they call the yield curve. So there's a thing called the bond yield curve. So the treasury yield. Um, one of the things that they look at uh, as far as kind of a potential indicator of a recession, or is whether or not the yield curve is inverted. So you'll hear this talked about um, quite a bit. Um, so let me zoom in on this a little bit. So if we look back in 1980 here, when we did have one, what this is showing is uh, the 10-year bond rate versus the 3-month bond rate. When the bond rate of the 10-year is higher than, or sorry, when the uh, longer term bond is lower than the shorter one, then it's called an inverted yield curve. Oh, I, I disconnected briefly there. So what I was saying is, when what this is showing is when the longer bond rate goes lower than the shorter bond rate, the likelihood of a recession goes up, because if you're holding a bond for longer, you're assuming risk, a greater risk. So if you're getting paid a lower rate for holding a bond for longer than holding a shorter duration bond, it's an inverted yield curve, is what they call it. So that tends to indicate that there's a higher likelihood of a recession. And historically speaking, that tends to be accurate, but only if it's sustained. If it's just a blip, if it only happens briefly, like if it just is inverted for just a short period of time, it not as not as likely. But if it's inverted for a long period of time, it tends to be a pretty good indicator. So that's what this graph is showing here. But um, so just another market correlation and things to be looking at. Um, so all of that said, just some additional things to look at. The big takeaway that I want to talk about here is slick charts. I really, really like this. If you are looking at things, if you want to take one thing away from this, I really, really like slick charts. You go on here and go up to the S&P component performance, and then scroll down to the bottom, find the underperformers, and look for some big names that you know and use, and um, take a look at their chart for 5 or 10 years, and see where they're at. See if you can find any that are at 5 to 10 year lows, and see if you can get some good deals on them. And those are going to be your potential winners for when markets are at high, at some of the high prices. You can find some really good values, even when markets are at highs, and find some really good entry points. And you can start slow. You pick up one or two shares at a time and start adding. And it doesn't have to be huge moves. But, this is it's a marathon, not a sprint. And we can just start adding a little bit at a time, and pick our moments. There's going to be opportunities for a very long time. You know, so this is not supposed to be a everything happens overnight kind of thing. We're just finding our opportunities as they come. We're waiting for them to come to us. And so slickcharts.com, and keep an eye on, just as something to watch and see as things progress, is watch how oil, inflation, and real estate, and bonds. Watch how all of that kind of plays together. How bond prices and the S&P kind of go opposite of each other. It's interesting to watch. And something else to pay attention to is when fear kicks into the market, things like gold and bonds don't necessarily go up right away. There's usually a sell off first. So people will usually want to sell those off to get some cash out before they want to, in order to deploy it, because a lot of folks don't have that 10 to 20% cash ready to go. They usually, most people don't have that waiting and ready to go. Most people are over extended as far as where they've, got all of their cash deployed. So a lot of times what you'll see is a sell off in stuff first when that quote unquote fear bid kicks in. And so um, it's usually also an indicator that there's fear in the market when you see gold and bonds sell off when the rest of the market's going down, and then things will kick back up. So just some things that you can watch for and start to notice. So yeah, some stuff some stuff I watch for, things that I like to just pay attention to, and things that I find interesting. So next time we're going to talk about how to build a portfolio that can be resilient no matter what, and that continues through ups and downs. How to make sure that you've got uh, a solid strategy to continue building not only cash flow, but continue building additional assets, as well as how to start developing a budget for major changes like a big move or a home purchase, things like that. So we're gonna look at that for the next episode. Yeah, I hope you found this helpful. If you have questions or anything, please, as always, drop a comment, hop over to the Discord, join me there. But yeah, thanks for joining me on this episode of Financial Fundamentals. Stay tuned. We've got another episode of our main real world recovery coming up in a couple of days. So yeah, looking forward to seeing you guys there. I appreciate